afternoon. Welcome to Hardman Talks. My name's Mike Foster. I'm the real estate analyst at Hardman Co. So this session is going to be a mix of a presentation by Yew Grove REIT. Yew Grove had their results last week. And at the end of the presentation, there'll be a fireside chat approach to a few topics that have come out of the presentation and the results, and some questions that have come from yourselves. If you saw the results, they were very encouraging. They posted an increase in the NAV, and the income and the dividend streams from Yew Grove have been very robust throughout the last year. So I think on the back of that growth in the NAV, I will introduce Jonathan Laredo of Yew Grove.
Thank you, Mike. Good afternoon, everybody. Over the next 15 minutes or so, I hope to give you an overview of Yew Grove, what we do and what we're about, and hopefully you will end up as enthused about our prospects as we are. Yew Grove is a REIT listed in Dublin and London, and we invest in industrial properties, particularly in the life sciences sector, and office properties outside the central business district of Dublin that are attractive to and suitable for multinational or government tenants. As a management team, we've been doing this for over 7 years, and we believe our value proposition is supported by the dynamics of the Irish economy and its property market. I'm going to cover those points in more detail in a minute, but the key is that the Irish property market is dislocated. Approximately 80% of all institutional investment in offices and industrial is focused on the central Dublin office market. And as a result, values in regional offices are almost twice as high as those in the CBD, or yields rather. Although the industrial market has sharply corrected since 2016, there is still significant value in some of the more interesting sectors. Many of you may already know the Irish economic story, but I believe it bears repeating. Performance of the economy has been outstanding over the past 5 years, and that has been driven by multinationals that are either situated in or attractive to the country because of many years of industrial policy driven by successive governments. The country is the European home for a huge range of businesses, particularly in high-growth sectors such as life sciences, ICT, specialized engineering, and finance. And those businesses, particularly life sciences and ICT, drove the economy to a net growth in GDP last year, making Ireland the best performing economy in the developed world, notwithstanding the severity and tenor of its lockdowns and the headwinds from Brexit. That comes on the back of 5 years in which Ireland has either been the best or the second best performing economy in Europe. The attraction to those multinationals or FDIs is manifold. It's English speaking, there's a clear legal and regulatory structure. It has an attractive tax rate, but the principal driver of growth over the past decade has been its domestic population and its open economy. The population is the youngest and one of the best educated in Europe, and Ireland's open borders and reasonable living costs, particularly in the regions, encourages highly educated immigrants attracted to working in rapidly growing business sectors to relocate to the country. The importance of this part of the business, this part of the economy can be seen from the employment statistics. FDIs employ just under 12.5% of the total workforce, and when you include local suppliers, that grows to over 22%. And more particularly, these are highly skilled jobs. Pay rates for FDI employees are substantially higher than the national average. And those multinationals are situated around the country and tend to cluster in industry groups, creating around developed supply chains and third-level educational establishments, creating specialized research hubs and tailoring their educational courses for the employees. That clustering effect means that even though very many small regional towns and cities are small by European standards, the size and quality of industrial and commercial activity by large multinationals is one of the key drivers of growth and higher paid employment. Those multinationals operate against a backdrop of a severe shortage of suitable accommodation, because from 2008, there was little to no commercial construction activity other than that sponsored or funded by tenants. And that began to change in Dublin in 2016, but only really began to change in the regions in 2018-19, even then to a very limited degree. So you can see the map here where we are invested. The markets in which we operate are very positive. Across our regional office markets, our tenants have been outgrowing the available suitable stock for some time, and that has underpinned increasing rents, and together with increasing investor interest is driving the market towards the sort of inflection points that happened in Dublin in 2016-17. We're very well positioned to benefit from this change. In our industrial market, investors and commentators have begun to see that Ireland's strength in life sciences is an increasingly attractive asset class and the one in which pricing and valuation has not caught up with reality. You can see this slide, which is accurate as of 1st of January, but has actually been overtaken by the events which Mike referred to in his introduction. We've had two recent updates created by New Asset Management and a valuation on March the 1st, which was required by the Irish Central Bank. We've got 25 buildings, just under 825,000 square feet. Our rent roll on the 1st of January was 11.3 million, and our vacancy rate was 4%. The portfolio valuation has been increased by just over 143 million from just under 142 million at December last year. The WALT to break has been increased to 4.8 years from 4.2 years from January the 1st. As you can see, we have a very high quality rent roll. We have 42 tenants. The largest exposures are on the right-hand side of this page. 25% of our rent is from government bodies. 76% of the balance is from publicly listed companies. And in the private companies are people like Aldi, a household name and a very strong credit in its own right. Over 53% of our tenants are publicly rated A3 or better, and most of our tenants are in very resilient industry sectors, as you can see at the bottom of the screen. The yield, in other words, the rents we receive divided by value, is currently 7.9%, with the reversionary yield, in other words, the market rent, of 8.7%. At this point, I'm going to hand you over to my CFO, Charles, who will take you through some of our financial highlights. Over to you, Charles.
So Jonathan's mentioned already the growing body of FDI tenants and employers in Ireland, and they form a significant part of the rent roll behind the company. And it's that rent roll that we've been watching over the last year in the time of the pandemic. Through that, we've been measured, first of all, by our collections. Our collections, rent collected, was 97% quarter two, 98% in quarter three, and then 100% for the last quarter and for the first quarter of this year. Those strong collections were of a growing rent roll, and our rent roll increased by 2 million euros over the year, partly through asset management and partly through the purchase of additional assets. That income and those collections allowed us to make distributions, quarterly distributions to shareholders throughout the period. In total, 5.15 cents of dividend per share was declared from earnings of the period. The prior year had been 6.75 cents per share. However, that included a significant extraordinary dividend. If that were to be removed, there would have been greater dividends, ordinary dividends paid last year than the year before. As well as income, our net asset value has increased as well. Over the year, that increased by 1.5 cents, even though we took on purchase costs of 25 million euros of assets during the period. Our NAV total return, or accounting total return, for the period was up 25%, being 6.3 cents per share versus 2019, 5 cents per share. And we have a strong pipeline ahead of us for acquisitions. The driver of this has been our growing property portfolio. Our portfolio grew by 23% last year, and at the same time, our contracted rent roll by 22% as well. If one looks at the right-hand upper graph, one sees that since IPO, our portfolio has grown by 5.5 times. However, through that period, when we have purchased assets, we've managed to maintain a broadly similar yield on those assets as we've gone forward. Not only is there a current yield on these assets, that being the rent roll, but at the same time, our portfolio is majority reversionary. As such, the valuers and our external valuers who value our portfolio every 6 months, when they view our assets, believe that if they were to be rented in the open market, we would have greater rental from them. As such, even though we're not purchasing assets, we've got the ability to gain further income from the high quality tenants mentioned beforehand. As well as growing income, what we do is we focus on the costs of the company. We're an internally managed REIT. As our portfolio has grown, so has the percentage of administrative costs over our portfolio size fallen, demonstrating our operational leverage. As we grow, we have a reasonably fixed cost base. And as we grow, one would see the further benefits of that additional income come through to dividends to shareholders. The next page looks at our dividends. What we show here is we have historically paid out the majority of our EPRA earnings per share in quarterly dividends to shareholders. And in 2020, our dividends grew from the first quarter 1.2 cents to 1.5 cents per share for our fourth quarter dividend. But it's not just about the income and the distributions we've paid as well. We also, when we look to purchase an asset, are aware that there are certain costs we have to take in purchasing. The majority of these being stamp tax. So of those purchase costs, which are about 8.5% of the value of the asset, we have to have a plan in order to regain those and recoup those. And we aim to recover those within 3 years. Now we've been in existence for almost 3 years. We can now look and see over the last 2 full years, what was our performance like in our like-for-like portfolio valuation change. And we see then in 2019, our portfolio increased by almost 5.5%. And in 2020, even in the pandemic, it increased by 2.5%. So from our target of growth of 8.5%, with 8% over the last 2 years, we're close to achieving that target with the assets, proving not only are we looking at assets for income, but at the same time, we're looking at assets that have valuation gain within those. And much of the valuation gain that there is in those has been driven by asset management.
Thank you, Charles. I'm going to briefly give you some illustrations of both the asset management and why we believe the portfolio has real embedded value. And then finally, I will touch on the pipeline we have in front of us. So the picture you see in front of you shows part of an IDA park in Athlone in the centre of Ireland. All of the tenants in the park are in the life sciences sector, and we own 5 buildings with 4 tenants, as shown on the slide. We bought those buildings over a 4-year period and are now one of, if not the largest landlord on this park. The key point is that there's no vacancy in this park and no industrial vacancy in the vicinity. The businesses that operate here have developed local supply chains, have ties into the Institute of Technology that is adjacent to this park, and are substantial employers of qualified and skilled workforces who are difficult to relocate. Most have also invested substantial value into their buildings, and businesses that want a site here either need the IDA to find them sites and construct new buildings, or must finance the work themselves. Existing tenants who want to expand in situ need a landlord who's willing and able to help that expansion. We've worked with our tenants for some time. We built the car park at point C on the map, and we've helped 3M expand from building D&E into building F. That's likely to undergo a substantial upgrade to become the European research headquarters for 3M's medtech business. We're working with the IDA and tenants to use the site at G to improve water and power for all of our tenants as they expand, and potentially as a home to resite the car park from C if and when we built an advanced warehouse for 3M. We recently announced that we're extending another building on the park with 37,000 square feet of offices and labs. We've agreed a fixed price construction with a construction company, and together with the cost of land, that will total approximately 10 million euros. But we already have in hand an agreement for lease, which will enhance both the yield and the values you see on this slide. So what does that mean for industrial values? You can see from this how our portfolio has performed over the past 3 years and how it might perform in the future. On the right, there are a few key points. There's no vacancy in this part of the portfolio, and that reflects the market. There's very little vacancy in the larger industrial buildings in Ireland. And because we've only completed 1 rent review and only let part of 1 building, asset management will play little in the changes in value. And you can see that this portfolio has increased in value in the bottom right-hand corner. The portfolio is still under rented. In other words, market rents are higher than the rents we currently earn. And as we negotiate more rent reviews and re-gear or renew leases, our rent roll will rise and the weighted average lease term will also extend, which should be good both for income and for value. But most importantly, even though the capital value of these buildings have nearly doubled, and that has largely been driven by tightening discount rates. Actually, we have a lot more to go. The current market, secondary market for industrial buildings is somewhere between 4 and 5%. And as you can see, our buildings are currently being valued at around 7%. A 2% tightening in that discount rate could mean a price change of up to 40%. This slide gives you some examples of how we manage our office properties. In the circle, you can see the 6 buildings at Millennium Park. We bought those last February for 25.3 million, as Charles mentioned. And of the 6 buildings, 1 was vacant and had been vacant for almost 2 years. Local agents did not consider this a hugely highly valuable park because it had very poor access. But because the M7, which you can now see in the photograph, had just been completed, and because we knew the interchange into the park was going to be opened in March last year, slightly delayed by COVID, we were confident that the park would do well. We actually let the vacant building to Aldi in July last year, in the teeth of the pandemic. We let it at a rent of $16.50 a square foot in a 15-year lease. And that persuaded the valuers to change the ERV to $16.50. Since then, we've agreed 2 rent reviews, one at 17 euros and one at 17.75 euros. And I think we'll be discussing ERVs with the valuers again. You can see in the bottom, in the boxes at the bottom of this slide, that the current value of the property is just under 27 million, 26.7 million, with a yield at fair value of 8.7%. And we believe with an economy which is exiting lockdown, that is a very cheap yield and has room for growth. Looking at this slide, what you can see is how our regional property values have grown in value. You can see from the top right of the slide, there has been no change in discount rates. The only change last year was a slight increase by the mid-year and then a reversion to the mean at the end of the year. All of the increase in values in the slide, in the portfolio, as evidenced in the bottom right-hand side, have been driven by asset management. By us the ERV increases, by us increasing WALT and reducing vacancy. You can see that even though rents and ERVs are increasing, there is still some way to go. Just to give you an idea, if you want to put up a 2- or 3-story building with surface car parking of the sort you can see in the picture on the bottom left, you need market rents of between 23 and 26 euros a square foot, depending on the land price. As you can see, our current rents are running at about 16 to 50 a square foot. So there is still lots of room to grow. The most important, and this is true also of our Dublin portfolio, just to give you some examples. We've got a property in Dublin where the valuers saw the ERV at 26 euros a square foot, notwithstanding we had evidenced asset management at the higher levels. They told us that whilst single floors might let for more, the building itself would not let for more than 26 euros a square foot. That was December last year. In February this year, we agreed a new lease with the ESB, with the government, for an entire building at 29 euros a square foot, 40% ahead of the rent they were currently paying, and 16% higher than the ERV from our third-party valuers. The most important fact about this slide is that discount rates are beginning to change. Increasingly, institutional investors are beginning to look at Cork, Galway, and Limerick. And we believe that the markets are approaching the sort of inflection point which changed the outlook in Dublin in 2016 and presaged the fundamental re-rating of that market. And finally, before I finish, I just want to give you a sense of our pipeline. The target pipeline is large and massively underinvested. We have a total pipeline for this year, in other words, properties we have been shown and have begun due diligence on, of almost 300 million. That comes from the natural delays we've seen in the market due to COVID. There are a number of funds out there which were either gated or are approaching the end of their lives who need to liquidate. There are developers who built new buildings and have got finance which is becoming increasingly expensive and would like to sell. We have investors who bought assets in 2013 and 14 and are benefiting from a tax break which said that if you held your asset 7 years, i.e. now, you could sell it free of tax. All of those people, plus the ordinary sellers, are ready to sell. We are seen as one of the preeminent buyers of regional properties, and as the only public REIT to do that, are increasingly approached. So that was a very quick run through what we do. The key point for most of the listeners here, or viewers here, is that whilst we have some cash on our balance sheet from our increased leverage, if we're going to take advantage of this pipeline, we need to raise more capital. We believe that any new capital raise, because we would invest it in this pipeline, would be accretive for existing shareholders and attractive for new investors.
Thank you very much, Jonathan. That was not only very interesting, but it triggers me to make the confession, which is that a couple of years ago, I hadn't really looked in any detail at all at Yew Grove. It's a medium-sized REIT and is easy to look over. And I think that the investor interest is going to be reaching an inflection point, just as the assets may be. Time will tell, obviously, but it strikes me that this is a secure REIT, relatively speaking. I mean, the rent collection and the reduction in vacancies makes that pretty clear, but there's scope for the revaluation. So, you know, it's not unique in that respect, but it is very much in a minority. I'd just like to make 4 really quick points, and then we can go into the Q&A, because we've got half a dozen questions. In that, you know, one of the most important points, I think, for REITs is as to whether they are going to go for income or capital returns. Income returns do tend to compound up rather more openly than do capital returns. I think there is scope for both here, but having a 7.9% yield on assets is a pretty interesting one. And when I first looked at it, I thought, you know, does that reflect on increased risk? But clearly we've seen effectively 0 defaults in a very difficult market in 2020. And so the 7.9% yield on assets doesn't seem to be due to a higher risk. And then there's the reversionary yield, 8.7, so there's upside. And one of the key things that we have seen in the past year as well is the reducing vacancies, reducing voids. The voids a year ago after the Millennium Park acquisition were a bit over 11%. And a number of those voids had been acquired, as Jonathan was saying. One of the attractions of Millennium was the scope to fill some of the voids. But also there was, as Charles mentioned, a special dividend paid a couple of years ago, which was an early exit fee from one of the tenants in a property which has now been part filled. So the voids were beneficial to the company and they've reduced significantly in the past year. The NAV total returns, that's a very important, interesting part of the 2020 proof of the pudding, 6.3 cents per share. And I think that one of the reasons for our interest in this REIT is the scope to grow. I mean, we like to see companies utilizing the stock market. Yew Grove have indeed already raised equity, but the 23% growth in the portfolio last year alone and the significant pipeline that's investable do obviously open up questions about, you know, the last equity raise may well not be the last one for growth. The first question is just really as to whether a feel for the market. Have you seen a change in the type of acquirers or indeed the type of vendors over the past year or so? I mean, clearly you've got experience over the many years in this market. So what sort of acquirers are you up against? Are large global REITs or are private individuals for their SIPs being attracted by these high yields?
I'll deal with acquirers first and come to vendors in a second. We have seen the market begin to change from the acquisition perspective. So when we started this, our principal competition were a couple of domestic players and high net worth individuals, depending on the location. But over the last 12 to 15 months, we've increasingly seen European institutions get involved. So we've seen people like M7 enter the market. We've seen Quorum, a French investor, enter our market fairly substantially. In the industrial sector, we see a multitude of people. An Australian company called Arrows come in. We've seen Blackstone get involved in industrial. So that GIC bought Exeter's portfolio. The most interesting thing from my perspective was that Decker, the large German pension fund, which historically had only really focused on the Dublin CBD, about 2 or 3 months ago, sent a team down to Cork to start looking at buildings there. So we think it's a good thing for more competition to enter this market, for the markets to become more transparent, because we think that some of the dislocations that we've taken advantage of would benefit from more competition, more transparency. That's helped. On the disposal side, the vendors, to be entirely truthful, in the last 12 months, we haven't seen a huge change because the markets were effectively shut from March last year all the way through to the end of the year. But as I said rather hurriedly in my presentation, what we have really seen are a mixture of vendors who've been in this market for a long time and who are now benefiting from their tax break. They can sell without any tax. They are from all over the world. They were people who bought opportunistically in 2013-14, so good luck to them. We've got a series of funds who have reached the end of their investment period, so whether that's 7 years or 8 years, and are starting to unwind. Their properties were bought more recently, but they're unwinding the funds. We've got a couple of funds who are gated, so they had retail investors who pulled their investments and they're selling. And then we have developers, and we've always done very well with developers. We have large contacts throughout the country, and most of those sellers want to keep the market and their sale relatively quiet, so we tend to deal with them off market.
A couple of sort of related questions, and the second one will be about hub and spoke. But Tom Eden was asking, have you seen COVID and associated effects such as home working affecting the ERVs in the office portfolio?
No, we expected, I think our valuers expected there to be a real discount, which is why in our valuation at the end of June last year, they actually pushed the discounts out on our office portfolio. But you know, as you yourself said, we actually let a building in Naas, we let a building in we let some of the building in Mallow, some of the building in Cork, and more recently a building in Dublin, all of which were offices. We had new leases in all of those buildings, and we reduced our vacancy. What we've actually seen is that hub and spoke, I think, will apply to Dublin because it's a city, albeit not to the scale of London. But that's where tenants will have a more expensive city centre office and perhaps some suburban or regional offices to make the commute more easy for their staff. In the regions, that's less of an issue. In the regions, what home working has done, or working from home has done, has meant that people are reconfiguring their offices. They have more meeting space, more communal space, less numbers of desks crammed into their offices. They're upgrading the feel of their offices, and they're expecting staff to work from home for 2 to 3 days a week. However, given that most of the markets have a substantial vacancy deficit, there is far more demand for the bigger, more modern offices than there is supply. All that means is that perhaps the forward pipeline of construction will be tempered. But at the moment, there's an excess of demand, and that's driving rents upwards. So we don't expect there to be an ERV tempering for the time being. We actually tempered our own expectations, but the only place I think that really applies is in the fringes of Dublin, where we currently let a building at 29 euros a square foot. Had COVID not happened, I think we would have probably been targeting 30, 31. But it was a great let nevertheless.
Have you seen any specific sort of inquiries or just sort of checking out the hub and spoke thing in your Dublin non-CBD portfolio?
Yes, we have. We've had a number of inquiries. We've had people like versions of WeWork approaching us asking if we would let them the building. We don't really think that's a good model for us. It's the operational cost is too high, and the tenancy risk is very different from the sort of tenants we like. But we know people are trying to set up specific managed offices. We have also been approached by a number of local councils who are looking for swing space for their offices because they're not certain how much space they'll need. Probably the most interesting thing for us is that both the HSE, which is the Irish equivalent of the NHS, and the OPW, who deals with most of the government leases, are looking for cheaper space, moving out of the centre of Dublin. And they're looking for space which works with their flexible working plan. They've told their staff they can work from home, but they're trying to reduce their overall costs and therefore want more regional space. And so those conversations tend to be much longer lasting. So people like the IDA have a very, very plush office just opposite St. Stephen's Green, but then they'll want smaller offices, cheaper offices elsewhere.
We were looking at the pipeline in our note, and clearly you're very committed to and very positive with offices. That's a high proportion of the pipeline. But on industrial, is it a smaller part of the pipeline, partly because the competition for acquisition there is getting pretty intense, and it's quite difficult to not overpay in that segment, although there's a revaluation coming?
Yeah, I think there are two reasons. One, just much less happens in the secondary market in industrial. Very little comes up to trade. And as you say, if it's in logistics or cold storage or data centers, the pricing has already changed. So we are seeing transactions in those markets at below 5%, not a market that we can compete in or want to. In our market, really, we see two sources of properties. One, the sort of forward financing that we're doing in our loan, where our yields are even better than we can get in the secondary market for very high quality new buildings. And two, what we tend to see is those developers in the regions who would rather their transaction was not in the public domain are happy to deal with us. And we can get those transactions at good yields. But so as a function of this total market size, we probably have the same percentage in industrial as in office. It just is a much smaller market in total turnover.
Another question from David. It's a small thing, but you've got a small part of your portfolio is in non-core.
Yeah.
Might there be sales to tidy up and at a loss perhaps in that area?
Well, there'll be sales. I don't think they'll be at a loss, but who knows?
Who knows? Yeah.
You'll have seen, if you've read our accounts, that we sold 2 buildings last year. We had a few smaller non-core buildings. They're non-core because they're smaller, they're not really institutional, even though they're anchored by good tenants, usually the government. So we sold 2 of them last year, and we sold them at a profit to book value. We've got another 3 to be sold, and we fully expect them to be sold in 2021. And I would hope that, taken together, they're sold above book value. It might be that one of the buildings is sold at a loss, but I think as a package, they'll be sold at a profit.
Okay, question from Caroline in terms of potential fundraisers. So this is not just a retail forum that we're on. There are wealth managers and others. But however, there's a sort of bête noire, obviously, of the retail investor, quite understandably, as to their potential for involvement. So would you be cognizant, and is there anything that you can say about future equity raisers and the retail investor?
Our view is that we need to widen our share register, and we would like our shares to be more liquid. And we think an important part of that is increasing the retail component of our investor base and increasing actually the participation by asset managers. Both of those are targets for us to improve, and which is one of the reasons that something like this is so good for us. And I'm going to hand over to Charles, and if we do a capital raise, how we hope to access retail investors. So Charles, I don't know if you want to say a word.
One of the things that we have been very fortunate with is that the majority of our share register remains pretty similar to what it was from the IPO, excluding those who came to us later. So we have a very solid register at the moment. Jonathan mentioned, however, that we need to add more in the way of smaller holders, high net worth, and retail as well. As such, we're doing more on the social media side. We are increasing the news flow that we have from the company as well. At the same time, we're going through a number of corporate governance things, such as a corporate governance roadshow, to ensure everyone is aware of what we are doing at the same time. And we'd like to think that should there be an issuance in the future, we would look for some way of opening a certain amount of that towards retail and towards other groups in order to widen out our share register.
In terms of UK REITs, when they acquire, we often see that they can avoid quite reasonably stamp duty by buying corporate vehicles. Is that not the case for yourselves? I mean, you seem to plug in very high acquisition costs.
It's not the case, unfortunately. Irish REITs can't use a corporate vehicle to avoid stamp duty. The only natural way is not to pay stamp duty is to acquire what is effectively another UCITS, and there just aren't very many of those around. Right. So fortunately, because we're in a market in which capital values are growing and will continue to grow reasonably significantly, it's a cost which everybody bears, but one that we can surmount. But unfortunately, no easy way around that.
the Yew Grove came out of a much smaller sort of, might be called seed fund, Yew Tree. And at that stage, did you rule out the Dublin CBD? You know, at what stage did you say this is not a market for us and we want to do what we're doing now, which clearly has been very successful?
I think the genesis of the idea was that we looked at the quality of the tenants, the covenants that we could see in the regions, and looking at them and seeing that you could buy the government or very good names at yields of over 7% looked very attractive. The same names in the CBD are available at 3.5%, 4.5%. And our view was that whilst the CBD might be an attractive play for developers, it was a less attractive play for a pure investor. Now, in the short run, Dublin rallied very quickly, and so that may not have been sensible between 2014 and 2017. But I think as we saw over the last year, you know, perhaps we were right rather later than we expected. But yeah, you know, we're more than happy to be where we are.
And from Richard, the 2020 acquisition at Millennium seems slightly strange that the vendor would not have sought to you know, fill the void space, and you obviously filled it within a matter of weeks. The motorway was probably a fairly hard thing to hide. So, I mean, you know, clearly things were going to be imminently better. So, you know, why? It's kind of, when did you stop beating your wife kind of question, but, you know, can you?
No, I think it's a fair question. I think the key point is like anything else. The vendor had been in situ for the best part of 4.5 years. Most local agents had come to the view that this park was really isolated by its lack of access. We knew the park well. We'd seen it a number of times, and it used to take you from the old road, which the motorway replaced. It used to take you had to drive half an hour past, and then half an hour back to get into the park. So it was a bit of a nightmare.
Right.
But we knew, and so the park was not that popular with multinationals. However, with the opening of the bypass, we decided that this was really going to change. And frankly, that view was not shared by valuers. The local valuers really thought we were wrong. They said I think they believed what we were doing was rather foolish. It was only really when we started marketing the property, and to be entirely honest, we started marketing slightly before we completed. We had 3 or 4 people competing for the property within weeks, and suddenly there was a sea change with the valuers, with the agents. We said, look, this is going much better than we expected. It was no real surprise to us, but I think that's because once you get used to something, the blinkers from what's the right word, from knowing it too well means you just don't see what's available. And we try to avoid that if we can, but I'm sure we will fall into the same trap at some point.
And it sounds like, in a way, the Millennium Park fortune favors the brave, but on the other hand, with the strategy in place, you don't really have to be that brave at all. So
I don't think we were brave. I mean, I think it was pretty clear what was going to happen there. It was just that you just couldn't see it. You couldn't see the wood for the trees if you were sitting in Millennium Park.
Thanks very much indeed for the presentation and for the insights that I've had over the past many months of looking at you. And I hope that more people look at you in 2021. Feedback.
Thank you, Mike. Thank you, everybody. Have a good afternoon.